So let's finish up chapter 10. Once we finish up chapter 10, then we'll be ready to take the next test, which will be, there we go, on, make sure we're, so 8, 9, and 10, next test. So we'll finish 10 today, which means we'll have a test on Tuesday. Let's do it right after class on Tuesday. How about that? We'll finish 10 today, and then we'll have a test on Tuesday, 8, 9, and 10. All right, so co-insurance. We just finished looking at deductibles. Now we're looking at co-insurance, and we're talking about property casualty. Okay, that's important. We're not talking about life. We're not talking about health. Okay, co-insurance. So it's a clause that encourages or requires the insured to insure the property to a stated percentage of its insurable value. What does that mean? That means that a customer that is insuring a piece of property can't have a low amount of insurance. It requires the customer to have a significant percentage of the value of the property covered. Okay? That's what it means. Okay? Have adequate coverage. If the requirement is not met at the time of the loss, then the insured must share in the loss. Co-insurance, different from co-pay or co-payment. This is co-insurance. Okay, this is to keep someone who has $1 million building from taking out a policy that covers $100,000. If everyone was allowed to do that, no one would take out full coverage, and the cost would be astronomical to the insurance company, and so would the premiums. Okay. All right. So here's a formula. So you're going to have to do a little calculation, not difficult. So you take the amount of the insurance that you actually have divided by the amount of the insurance that is required in the co-insurance clause, and you multiply that by the loss to see what the insured, what the customer is going to have to cover. All right, so a building has an actual cash value, which is replacement value minus depreciation, of $1 million. Okay. The co-insurance requirement is 80%. So the insurance company is saying that you must have at least $800,000 of coverage. Okay, you cannot take out a $600,000 policy. If you do, then you're going to be a co-insurer. We'll let you do it, but you're going to have to step in and be a co-insurer. Okay? And so let's say the owner takes out a $600,000 policy. All right. So a loss of $100,000 happens. Say there's a flood. Okay. There's a pipe ruptures, and so water damages the building to the tune of $100,000. Okay. So you look at that and say, well, they got $600,000 worth of coverage, which means the insurance company is going to cover all of it. No, it's not. No, it's not. Because they don't have adequate coverage. Okay? So the insurance company will take the $600,000 divided by the requirement of 0.8 times $1 million, $800,000. So the insurance company is going to cover 2/3 of it, 2/3 of the $100,000. Actually, that's 3/4, isn't it? Yep. 3/4 of it. And that leaves $25,000 co-insurance, which is, I'm sure, a lot more than the premium that the customer would have paid if they had had $800,000 worth of coverage. Okay? So again, the insurance company, they don't want to play games with people under insuring. That's why they do this. All right, as I was saying, the goal is to have fair pricing for all customers. All right, so if they start cutting deals left and right for different levels of insurance, then the cost to the insurance company would be really high, which means y'all don't have this? You don't?
It's just worded a little bit differently.
Okay. All right, well, this is pretty similar to what's on the previous page, actually. Okay. All right. So the insurance company might offer a discount on the rate if you go ahead and take out a higher amount of coverage. Okay. All right. So this is pretty much a repeat of what was on the previous page. Why do you take out why do insurance companies have co-insurance clause? Okay. This idea of if you take out more coverage, we'll give you a rate discount. That's pretty standard stuff. Okay. The insurance company is trying to spread costs fairly. So if you're going to try to take out a policy that doesn't cover adequately, then the rate, not the total premium, but the rate will be higher to discourage you from doing that. Okay? So this is something that you need to keep in mind. The amount of coverage that you have should be reviewed, because if you have a $1 million building and your co-insurance clause is 80%, and you take out $800,000 worth of coverage, and then your building rises in value to $1.1 million or $1.2 million, you're not going to have adequate coverage. And you're going to get penalized, and you could be surprised. You could have a loss. The insurance company comes in, they do an appraisal of the building, they find out it's worth $1.2 million, you only had $800,000 worth of coverage, and all of a sudden you're a co-insurer and you didn't know it. You didn't know it. So as a risk manager, that's one thing you have to stay on top of, is understanding the value of your business, or your buildings, your assets, and what your coverage requirements are. Because that'll cost you your job. If you get caught in a co-insurance position, you know, the CEO is probably going to call you up and say, you didn't do your job, you're fired. Oops. All right, co-insurance in health insurance, a little different, okay? So with co-insurance, you pay a specified percentage of covered medical expenses in excess of the deductible. So let's say you have a health insurance policy and you have a $500 deductible, okay? What that means is every time you go to the doctor, you pay out of your pocket for the cost of the doctor until you hit a total cost that year of $500. So the first $500, it's all on you. Okay? So let's say you go back, you've hit your $500 exactly, and you go back and you get a bill for $100. Okay? Well, if you have co-insurance, then let's say it's 20%. So what it will say is you have a co-insurance of 20%, so you have a $100 charge at the doctor, you have to pay $20, and the insurance company will pay $80. That's how it goes with co-insurance. Okay? That's a specified percent. And I can tell you on the licensing exams, they will give you several different scenarios with health insurance and ask you how much the client is going to have to spend and how much the insurance company is going to spend. And it gets really difficult keep up with that. All right, $500 deductible, co-insurance 20%. There you go, I didn't even know that. The customer has a $700 deductible and 20%. They incur a medical bill of $1,500. This is a typical question on an exam, on a licensing exam, okay? All right, so the liability is the first $700, this is the customer's liability, plus 20% of the remaining $800. Okay? So that's what the customer would have to pay for out of the $1,500. And let me tell you, you can run up a bill of $1,500 really fast. I think my son's ACL bill ended up being like $25,000, something like that. Maybe more. All right. Again, anytime the insurance company is asking the customer to retain some of the risk, they're doing that to try to keep the premium lower. Remembering that the purpose of insurance is not to pay for a loss that you could easily pay for. If there is a loss that you can easily pay for out of your pocket, you don't need insurance. Okay? Insurance is for, remember, an infrequent loss that is very large. And so your premium is very small compared to the potential loss. Don't forget that definition of insurance. Okay? Some people forget about that. All right. Other insurance provisions, okay, means that if you have other contracts, you're not going to make a profit on a loss. That's another dimension or definition or characteristic of insurance. It's not to make you rich. It is to make you whole, to help you recover what you lost, but not enrich you or give you more than what you lost. Okay? So, if you have more than one contract, you're not going to recover more than the value of the property. So this comes into play when you have more than one company or policy on covering a loss. So there are two ways that losses are determined using the other insurance provisions. One is called the pro rata liability, okay? And it's real straightforward, each insurer's share of the loss is based on the amount of coverage, okay, that each insurance company has. So it's really straightforward. And then you have contribution by equal shares. And it's a different calculation, which we'll see in just a second. So each insurer shares equally in the loss until the lowest limit is reached. Okay? Or until the full amount is paid. So let's look at two examples and it'll become clear. All right, so this is pro rata. So a company owns a building worth $500,000, and because of underwriting limits, which means the insurance companies don't want to take on the entire amount of loss, so they put together an underwriting group. So three different companies are going to insure this building. Okay, Company A says we'll insure $300, Company B $100, and Company C $100. And the way it is structured is pro rata. And you remember when we had the risk manager come in, he talked about a different way to allocate the loss, the potential loss. Okay? All right, so we have a loss of $100,000. Okay? So how is that going to be allocated? Well, very straightforward. Okay? So the total amount of coverage is $300, $400, and 500,000, and that goes in the denominator. And then company A is picking up 300,000 of the 500,000, so that's 60% of the loss times the 100,000, 60%, 20%, and 20% under pro rata. Okay? Now let's look at contribution by shares, equal shares. All right. So let's look. All right, so company A, this is a liability policy, 100,000, company B, 200,000, and company C, 300,000. Okay? So there's a loss of 150,000. Okay? So how would that be covered? Pretty straightforward. Okay? And the 150 is below company A's limit of 100. And so you take the 150 loss and you divide it by 3, and you get 50, 50, and 50. Because the loss is the loss split 3 ways is beneath the 100,000. The highest loss that company A will take is 100,000. So if the loss was 300,000, it would be 100, 100, 100. But if it was 400,000, it would be 100 and 150 and 150. So no company ever goes above what their limit is. Okay? So here's another example. All right, now assume a $500,000 loss happens. Okay. So contribution by equal shares, 100, 100, and 100. So that's 300,000. Now there's 200,000 left to be split equally by these two companies. So that's how they would do it. Okay, so you can do the math that shows you where, at what amount. So it would have to be 100, 200 is 300, and 200 is 500. So it would have to be above 500 for this company to have more risk exposure. Okay? All right. All right. Primary and excess insurance. And this is similar to what Mr. Gentry was telling us about when he spoke to us, the risk manager. All right. So you have a primary insurer that picks up to the first limit, and then the excess insurer doesn't come into play at all until or unless the loss goes above the limit of the primary insurer. So that's different from pro rata or contribution by equal shares. Okay. Bob and Jill went up the hill. Bob and Jill are married, and each has a car. Welcome to America. Bob's car has a liability limit of 100,000. Jill's policy has a liability limit of 50,000. Bob injures someone while driving Jill's car. Why do you think Bob is driving Jill's car?
She got the nicer car.
Maybe she has the nicer car. Yeah, maybe Bob's just bored driving his car. What's another reason why Bob might be driving Jill's car?
His car's in the shop.
Maybe his car's in the shop. And what is a third reason why Bob might be driving Jill's car? Jill says, hey, Bob, how about run around the corner to the grocery store and pick up some milk for tomorrow? Bob goes outside, and guess what? Jill's car is parked behind his. So he grabs Jill's keys, jumps in the car, and goes. Okay? All right. The policy on the borrowed car, okay, 50,000 is primary. And this is automobile insurance, and we're going to get into auto insurance. And it can get, once again, it can get a little bit sticky. So who's primary? Jill. Jill's policy, 50,000, okay? Bob's policy is excess. If the liability is 75,000, then Jill's policy will pick up the first 50, and Bob's will pick up anything above that. Up to 100. Where's Bob's? Up to 100. So their limit together is 150. If it goes above that, hopefully they have an umbrella liability policy that will cover it. If they don't, you can bankrupt them. My clock's not working at all. All right. I thought, man, we haven't taken up any time at all. All right. Okay, coordination of benefits, okay, in group health, okay. Once again, just making sure, so the insurance companies are going to work together to make sure that coverage is allocated fairly and that the an insurance company doesn't get stuck, or that doctors don't overcharge, or that the customers don't get reimbursed too much. Okay? So this would happen if you have a couple and maybe they have kids, and mom works at one place and she has insurance there, and dad works at a different place and he has insurance there. Okay? All right, coverage as an employee is primary to coverage a person might file as a dependent of a spouse or a parent. Let's see if we have an example. Yeah. Okay. All right. Man, Jack and Kelly are married. Work, each has insurance. Okay. Each is a dependent on the other's insurance. It's backup. That's why you do that. Make sure you've got adequate coverage. You know how much a bypass surgery costs? Anybody have a mom or dad who's had heart bypass surgery? It's like $250,000. My dad had two of them, 12 years apart. It's major surgery, but it's like $250,000. All right. If Jack incurs medical expenses, his policy will pay first. And anything that is not paid by his policy, he can submit to Kelly's policy. Now, this is interesting, and this is on all the licensing exams. With regard to children, so Jack and Kelly have kids, the policy of the parent who has the earliest birthday in the year is primary